If somebody you don't know came to you and asked you to borrow a couple $100,000 and they're going to repay it over the course of about 30 years, you would probably want to know exactly how they're generating that money so that they can repay that loan. Well, this is exactly the same thing that mortgage lenders are doing, right? And as a loan officer, when we're taking an application, that's the most important thing we're trying to figure out is what's the source of the income, how long have you had that source of income, and how stable is it, right? And also how much is it, okay? Especially for a conventional loan, the most important thing on a mortgage application is the income. The second most important thing is the income, and the third most important thing is the income. It's not credit. We can get you a loan with a 580 credit score, right? Theoretically. It's not assets. There are scenarios where people can close on a loan and put very little money into the transaction. But income, there is not a loan program out there that's not going to require some kind of source of income that's getting reported on your tax return. And so this video is all about the difference between the income that you're just receiving, right, however that is, and qualifying income for a mortgage, because they are different things. And I see either deals break all the time. I see people making all kinds of money who can't qualify for a loan, and it really trips up a lot of people. So I wanted to make this video in hopes that from somebody watching it out there, it either helps save a deal or help somebody else get qualified so that you can get to the closing table and get those keys, right? So let's jump in. So the main thing that a lender is going to look at is the stability of the income, like how long have you been receiving it, how stable have the values been that you're getting paid, or the income that you're generating for yourself. And the gold standard of income is salaried income. You don't even need to have started the job, right? If you have an offer letter saying that on this date you're going to start and this is how much you're going to make, that's all we need. We can literally use that so long as you'd be starting that job within a certain time frame after closing. We can use that as if it's income for you, right? Because salaried income, it doesn't matter how many hours you work or any of these kinds of things. Salaried income is the gold standard. It's stable. And so if you have a salaried job, that's great. We can use that relatively easily as qualifying income. Now, the next, I guess, easiest income to qualify with is hourly wage income, right? So if you're working on an hourly wage, that's considered a variable type of income, because maybe 1 week or in one pay period, you work a certain amount of hours and they pay you this much, and then the next pay period it's this much, and it kind of dances around, right? Nursing income, for example, they work on these shift differentials that for this shift differential at this time in this location, looks I get paid this much, but over here it's this much. So it can get a little bit more complex looking at hourly wages. Well, we're going to look for documentation that shows the stability of that income. We're going to typically have to average it over the previous 2 years amount of time to find out how much are you typically making, and how much are you typically reporting, right? There's that super important topic coming back up again, is how much income's getting reported. But typically, folks that are on a salary or folks that are receiving an hourly wage, they're so-called W-2 workers, where those taxes are getting taken out with each payment. So we don't have to worry about if they're reporting the income. It's getting reported automatically, right? So those are the simple types of income to qualify with. Then there's the self-employed category, right? Now, 20% of self-employed, or 20% of businesses fail within the first year, okay? Lenders know this. And so that's why if you're self-employed, we can only use your self-generated income if you've had that business operating for 2 years, right? And we're going to look at that average income. What did it generate you as far as income for those 2 years? And so if it's been operating for 5 years or more, then sometimes in certain circumstances, we can just use the most recent years. But this is why self-employed income gets a little tricky. Another reason is because typically what a self-employed person is generating, right, for their income is not everything that they're reporting to the IRS. And so, like I've said before, we can only use the income that's getting reported. I know, not my rule, but that's just the way that it is, right? Because it kind of makes sense that you can't tell the IRS, I'm only making this much, and then turn around and tell a mortgage lender, oh, look at all the money that I'm making. Can I please have a huge loan? Right? It has to be consistent, and that's where they look at to see if someone's telling the truth or not is their taxes, right? And there's all kinds of great tax preparing scenarios or strategies where they try to report as little as possible, but that cuts against your qualifying income when it comes time to qualify for a loan. And I've seen it happen too many times where somebody's self-employed, they're making all kinds of money, but they're not reporting enough of it, or they're not reporting any of it, and they can't qualify for even a small loan. Those are very difficult conversations to have with somebody. It's like, I know you're making all kinds of money, but for a conventional loan, we can only use what's getting reported on the tax returns. There are, these other types of loan programs like non-QM, they're called, or the non-conventional types of loans, that we can just use bank statements. We can just look at the deposits hitting your bank statements. We can use that as income, and we don't even have to look at tax returns. There's asset-based loans that just use assets, or that you're paying yourself from an asset. Or there is so-called DSCR, which just uses the rental property income as the income used to repay the loan. But those are special types of loans, and that's not the kind of conventional loans that I'm talking about in this video. And so if you're on a 1099, if you have an S Corp or a C Corp, or if you have rental property income, if you're talking to a loan officer and you tell them, look, I'm self-employed, or you have a bunch of rental properties, if you talk to a loan officer and they don't ask for your tax returns, run the other way, right? Because they could be setting you up for a huge, expensive, and sad surprise later on when you get into underwriting. You've already given somebody an earnest money deposit. You paid for appraisal, paid for title work. You're like starting to see yourself with the keys in that property, to find out that, oh my gosh, what? We don't have enough income, but I'm making so much money. Just show them the bank statements. No, it's not on the bank statements. If it's a conventional loan, we have to see the tax returns, right? So make sure that you're talking to a good loan officer. Right? If you want to know what your qualifying income is, please reach out to me. I love having these conversations. I love getting to the bottom of it and figuring out, because the learning curve is steep for us as loan officers. Is the hardest thing to figure out is the income. What is someone's qualifying income, and what are the documents we're going to need to see to show that and to justify it, right? So reach out to me if you have any questions, if you think you need some help. But thank you very much for watching, and I'll see you next time.